All right, what is up, traders? What's up, tycoons? Super excited for today's video. We got to talk about the bond market. Treasury yields seem to have put into the top, but could they be heading for a reversal and trying to break out past those new highs? That's something that we need to be prepared for. Now, we're also going to go over some possible bullish scenarios for the bond market, okay? We're going to take a look at the setups that we talked about in the last video for TMF and TLT. All right, and they're setting up perfectly, almost going exactly as how we talked. So we're going to break down all of that in today's video. Be sure to smash the like button, subscribe to the channel if you guys are new, and we'll go ahead and get straight into it. Now, we talked about TMF. Okay, TMF is one of the ones that we talked about, and we talked about an inverse head and shoulders potentially setting up here, right? And that's the play that we were looking for. All right, if we zoom in here, we can see that, we have our inverse head and shoulders setting up here finally on TMF. And from a risk to reward standpoint, things don't look so bad. We'll break this down even more later in the video. But before we do, we really want to talk about treasuries, right? We can see we have the left shoulder here. You can see we have the right shoulder. And, we came up to our level here of resistance. And, we talked about a possible pullback and forming a right shoulder right here, right? You can see the left shoulder, the head, the right shoulder, big, nice smiley face right here. All right. But as I mentioned, we want to pay attention to treasury yields, right? And this is the 20-year treasury bullish ETF. So let's actually take a look at our 20-year US treasury and see what's happening over there. So we're going to break that down real quick, and we'll throw in a nice little line chart just to make things nice and simple for you guys. And you can see, what did we do? Well, it appears that we're attempting to put in a double top, right? We have a top here, we have a top here, and, we're showing signs of putting in a double top. But as I mentioned before, it's not a double top until you break the neckline, right? That's when you get the M pattern to form. And that's when it's really a double top and actually confirmed as a double top, right? And that would give you the nice little M pattern here. And that's when we were looking for potentially the 20-year treasury to come back to lows of around 3.2, right? Just north of 3.2. But at the moment, right, everyone is calling it a double top because we come up to these levels and, hit some resistance. Now, what happens if this is the case, right? What happens if we end up forming a cup and handle right here? That's something that you need to keep an open mind about, right? We need to be prepared just in case that this actually turns into a cup and handle, right? If treasury yields only pull back for a little bit just to break out again, that's going to invalidate your double top pattern here, right? And potentially form that cup and handle. Okay, now it doesn't even have to pull back that far. What if we just break through, that previous high over here? What if we're actually able to break through and, get a little bit of a break retest and push up higher? That's also a scenario that you need to keep an open mind about, right? We've got some inflation reports coming up in September. We've got the next Fed, rate decision, whether or not they're going to, cut rates, raise rates, or pause. We'll have to see. Right. A lot of people have been pricing in a 25 basis point, rate hike. And now the market is actually starting to think that, hey, maybe they're not going to do that 25 basis point rate hike. Now, at the end of the day, we can't predict that stuff. We just have to prepare for possible scenarios, right? So while it does look like a double top is forming, again, we haven't got the confirmation here until we break through our neckline, right? That's going to be the true confirmation. Until then, we're just hitting resistance. We're just hitting supply, on the treasury yields for the US 20, right? And even when we take a look at the US 10-year, okay, we went over a very key level here, and you can see, it's again acting like resistance, trying to put in that double top, right? And when we zoom out and take a look, we can see just how important this 4.25 level is, right? Old support becomes new resistance. We see old support here, new resistance, and now the big question is, does this become resistance again, and do we fall back down and start to get that double top to form, or potentially do we creep back up above that 4.25 percentage area? These are some things that you really need to pay attention to, right? When you look at the longer term perspective, we had a very strong impulsive move here, right? We had a 1 up, 2 down, 3, 4, 5. And it's very possible we got an ABC correction and could be starting another bullish cycle up here, right? Now, I don't want to come off as, all bearish. I'm not, totally bearish. I am long TLT. Okay, I do have some, some hedges, but, ultimately, treasuries are very attractive right now, and the yield that you can get on these long-term treasuries, we haven't been able to see in a very long time, right? Especially even short-term treasuries. All right, I want to give a quick shout out to the newsletter, which, this is an example of one of the most recent trade ideas that we put into the newsletter. All right, giving you guys some key levels and showing you, how you can play things both ways, right? We're looking for the breakout to the upside above a key level, breakout to the downside, below a key level, below trend line here. And, just some different trade ideas. I like to include these trade ideas a couple times a week in the, newsletter. There's also a website associated with it. It's completely free. You can sign up using the link in the description or in the comment section down below. But I actually talked about, treasury yields today in the yield curve. And I mean, 3-month T-bills, guys, are at a 5.32%, right? Again, we're looking here at the 10-year and it's below the 10-year, right? It's very simple, yield curve inversion. We talk about the yield curve inversion here. And we also talk about how, this doesn't have to be a bad thing for everyone, right? The top 1%, right? In the top of companies. And in this example I gave in the newsletter, people like Apple, they can really take advantage of this, right? It sounds like, it should be bad for everyone, but when you take a look, Apple and companies with, top tier credit, what they can do is they can go out and they can take long-term debt out now and invest that into short-term instruments that yield higher returns, right? And that's what I kind of talked about in today's edition of the newsletter, about how it's like borrowing at 2% and then investing at 4%, pocketing the difference as pure profit. And I go over, how it works and why it works. And, these are just some of the things that, we're going to talk about in here. I talk about a lot of things, talked about individual stocks, equities, commodities, different sectors of the market. In this one here, we actually went over treasury yields, right? And we kind of gave the big level there, right? We talked about the difference in the 30-10-year spread, right? Why this is important. This is actually pretty important. And you can see this is that same chart that we're looking at yet now, the 10 years breaking out, and it was before that double top was formed. And, we already gave you guys that key level. So now that we've looked at the 20-year and 10-year, the last one we'll take a look at is going to be the 30-year real quick. And the 30-year has, started to gain a lot more attention ever since Bill Ackman put on a very big short on the 30-year treasuries. And you can see, I mean, when you take a look at this, guys, it's broken a clear downtrend, right? And this is a multi-year, long-term downtrend from the 2000s, right? So basically like a 2-decade long downtrend, and we're seeing treasury yields rise, and break out of this downtrend. So the big question is, like, is this going to be the new normal, right? Do we actually think that treasury yields are going to go back down, significantly towards the new lows, or potentially, maybe we get that double top and they come, the 30-year comes back down to around 3%. And maybe it just starts to hover here, guys, for a long time. Maybe these things continue to break out. The 30-year is actually already above a key level and holding above a key level right over here, which is at 4.2. Good old 420. And, that level has been a very strong level in the past of support. And we really haven't tested it as resistance, right? We've broken out above it here. We've broken out above it here. The big question, if we were to zoom in, is, what's it going to do, right? If treasury yields do start to fall, and that's going to be bullish for things like TMF and TLT, is the 30-year going to come back down to this 4.2 area and actually try to find some support and start rallying back up towards 4.6, maybe even 4.8? 4.8 is going to be another key level here. You can see, it's right around support over here, right? Support, and then we start flipping right around that area to resistance. So, these are things that you guys need to be paying attention to, especially if you're trying to trade things like TLT and TMF. Now, let's actually go ahead and, take a look back at TLT first real quick, and we'll break down TLT and, kind of what we're seeing with the price action there. TLT, also has that inverse head and shoulders setting up here. And I just want to talk about how I mentioned, that good risk to reward ratio and some of the other, key factors. Now, if you're not subscribed to the channel, definitely make sure you're subscribed. A lot of people really did not see treasury yields coming back down to the low 90s. But I've been talking about this gap down that we've needed to fill since November of last year and been very patient, right? We had a clear, basically a bear flag forming here with this pennant, with this triangle pattern. We broke through there and we essentially got the bear flag to play out. trying to form a little bit of a double bottom here. The big question is, has this all been a dead cat bounce? And are we going to potentially retest these lows, if not try to break through them? If we do, we have some levels here around 87, I think is where price could actually drop. We'll have to see. But in the short term, right, when we look at possibilities and trading opportunities, and we zoom in on this thing here, you can see, clearly that inverse head and shoulders that we have setting up. We'll go ahead and draw it again for you guys on the chart. But, we have our left shoulder here, we have a head, and we came down right around our level. And, when you take a look from a risk to reward standpoint, and again, holding right here, right around this key level of 94.80, 94.75, 94.70, those are the key levels of support we bounced on before. And, potentially we're going to look to see if we can bounce here again. But if we were just to throw a simple risk to reward ratio on here, these blue boxes are gaps, as I mentioned before. If you want to go long to see if we fill the gap fill up here, it's about 99.50, right? And you want to have a stop loss, let's say right around here for the gap fill to the downside, or even, to your support level down here, below 93.22. Right here, this is a nice 3.5 risk to reward ratio. Okay. Now, if you were to stretch this out below, it's going to skew it a little bit, right? But here, you're giving yourself a little bit of breathing room just in case it does come down and fill that gap. And, you want to see, hey, well, I want to see, can we actually fill this gap up? Right now, that's going to invalidate the inverse head and shoulder structure. But this is just a good example of the way that I would play this, and I don't have any positions currently at the moment to play this type of setup, this type of play. I was actually looking at going short here, and I really regretted not going short because it was a big move to the downside. I already had some short positions, from over here in these days, and I was looking to maybe add here, but I didn't really pull the trigger. But anyways, if you were to simply just put, your stop loss right above the gap, right? So let's say you don't want to get stopped out, or you don't want to be there for the gap fill. If we fill the gap down here to about 93.45, and let's say you're not going to be as aggressive, right? You're going to play, the first gap up that we have to fill, right? Look at the risk to reward ratio there, guys. It's 5.89. These are the type of risk to reward ratios that you want to be looking for yourself. I mean, you at least, of course, want to have a 1-to-1. But the thing about that is, you're not really giving yourself any room for margin of error, right? When you have a high risk to reward ratio, meaning, if you're risking $1 to make $3, right? You can be wrong twice, right? And if you're wrong twice, you lost $2. But on that third trade, if you're successful, you made $3, right? And so now you come out of those three trades with a net gain of $1, even though you only won one trade, right? So you're only successful about 33% of the time, but you're setting yourself up for good risk to reward strategies, right? And that's something that, a lot of people have some misconceptions about. One thing about this gap fill up here is this purple line is not a moving average. This is actually the quarterly anchored VWAP. And so we can see that the quarter today anchored VWAP is right here at the top of this gap fill. Institutions like to do a lot of buying and selling at these anchored VWAPs. You can see over here that the previous weekly anchored VWAP had turned into support. Right. And, we were just, hovering above that. And then we actually broke through it. Once the new week starts, we're going to have a new weekly anchored VWAP. And, that's going to be an area where we'll see, is that trending down? Is that trading down? Is that trading up? Are we able to stay above the weekly anchored VWAP? We also have a new monthly anchored VWAP that's about to start for September. So, that data will develop more as, the month of September goes on and moves along. Now, when we take a look at TMF, again, you're seeing a very similar setup. We have two gap fills up here and here to play. It's a little bit of a much cleaner chart when it comes to TMF. And, again, we come in here and let's say, we're entering here at this position. All right. And we're putting our stop loss, right here, right around the gap. Okay, the gap down, that is, and we're looking to play the gap up. That's basically a 4-to-1 risk to reward ratio. If you were to play the second gap up here, that's a 6-to-1 risk to reward ratio. And so you're not always going to be able to find these opportunities and find these type of risk to reward ratios. But these are things that you want to consider, right? As I previously described about, you don't have to win every single trade. And even when you find a strategy that works and that you can be consistent with, it's not going to be consistent all of the time, right? The big thing is that everyone gives up, and that's why people tend to not see success in the markets, is because they give up. There's people that have been trading for 10 years, 20 years, 30 years, and people just don't realize that they don't win every single trade, right? They may have, one specific strategy they trade 12 months out of the year. And guess what? There's going to be an entire month. There's going to be a bad month where that strategy didn't work. There could be 2 bad months. There could be 3 bad months. They could be in a row. You could have 3 bad months of trading in a row, but those people just don't give up. And they know that over time, they can be profitable with their strategy. They can be consistent with it. And they don't let the times when it's not successful, scare them out of the market, right? They stay consistent with it. Maybe they learn from some of their losses, see how they can improve it. Maybe they were just a little bit too emotional and, trading off of emotions too much rather than just, trading based off of, the strategy. So, these are all things you guys want to keep in mind moving forward. And hopefully you enjoyed today's video. If you did, smash that like button, subscribe to the channel, and don't forget to sign up for the completely free newsletter, giving you guys really good investment intelligence, along with, sprinkling in some free trade ideas in there every single week. It's a great way to support the channel while also helping yourself if you're a fan of, free valuable content.